Hi, everyone. This is Jason Byrne of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 25 years experience covering gold stocks and commodities. He is a chartered market technician and master of financial technical analysis. He also is editor and publisher of thedailygold.com. Jordan Roy Byrne, thank you for joining me.
Hey, Jason. Thank you for having me on. Thank you for that nice introduction.
So, Jordan, we're recording this interview on Friday, June 7th, 2024. The gold price today over the last couple of days, it's just gotten taken to the shed. I think it's down about 8%. But really, since March, there's been, I would call it a paradigm shift in the US dollar gold price. You've been talking for a while now that you thought a long-term price target was $3,000 gold. Were you surprised at the move that the gold price in US dollars has made from March up until the last couple weeks?
Yeah, I mean, I am surprised because I had thought for quite a while that, we needed to see equity market weakness for gold to really break 2100 and get into a new bull market. And so gold was able to break out with the stock market still trading around all-time highs, which is really, really bizarre. Now, the one comparison to that, or if you go back in history and try to find a comparison, would be the mid 1960s. You had inflation breakout in 1965, I think, or 1966. It really started to push higher. It was kind of dormant. I think it was around 2% or so. Then it started to pick up. By my own calculation, the bond market broke, I think, or it started to break at the end of 1965. Then it was clearly in a secular bear market. But at the same time, in late 64, the gold stocks broke out from a 28-year base. They had this massive breakout to new all-time highs. Yet the stock market was still trading around all-time highs at the same time. And so ultimately, the stock market kept going up for another 4 years at that point, although the gains in the stock market were really muted. And in real terms, I mean, you could say the stock market, I mean, in real terms, the stock market definitely peaked in 66. But if you're using the gold stocks, then it peaked in the, somewhere in the early 1960s. And remember, people could not buy gold at that point. So if you wanted, kind of an inflation asset, or if you wanted some exposure to precious metals, you had to buy gold stocks. So basically that, what was going on at that time in the mid 60s, not perfectly similar, but very similar to where we are now with respect to, you had the gold market breaking to a new all-time high. The bond market was cracking or had cracked, and the stock market was still at an all-time high. But it still the move in gold really surprised me because I did not see it having this strong of a move with the stock market. We're still in a secular bull market. I mean, granted, it's getting long in the tooth here, but we're still in a secular bull for the stock market. And so that move in gold did surprise me. But so I think, and I know we'll talk about this more later, but I think money coming out of bonds like that has definitely helped gold quite a bit. There's obviously the central bank buying and all of that. So that propelled gold to this massive breakout. Yet you don't have the secular bear market in stocks yet. And so eventually when we get that, if we get that in the next, even this year, next year, whenever, that to me is what will really propel this bull market in precious metals. And we need that, by the way, I think, to get to 3,000, 4,000, 5,000. Like I would be shocked if you have gold trading at 3,000 and the stock market is still at an all-time high. So that I think that to me is where the market is right now. But I definitely was surprised by the move because it's just, well, I mean, considering gold, because, I was talking about the gold stocks in the mid 60s. So considering gold, the history is only freely traded since 1971 or 72. And considering the history, and if you're just looking at gold, this is the only time you've seen it at all-time highs with the S&P still in a secular bull market.
So you don't think then that if the other central banks in the G7, say like the Bank of Canada just started cutting rates in the last day or two, the European Central Bank just did their first rate cut since 2019, that if those other central banks start to cut rates and provide the system with more liquidity, that it can't mean that all these assets start to rise together then?
Well, I think that that will certainly help gold. I think last interview, I talked about the relationship between, usually you get market peaks around the time the Fed is cutting, unless you're in an economic soft landing, and now it's, we're getting closer and closer to a recession. I mean, I probably said that a year or 2 years ago, so we're not there yet. But I think at this point, most people can see we're getting closer and closer to a recession. So I think if the Fed um, has to cut rates over the coming months or later this year, um, you could get you could get like a false rally in the stock market for a quarter or two, but based on the cutting. But in the bigger picture, um, I think the Fed having to cut, because the economy is headed towards a recession, I think is that will be the huge catalyst for gold more so than Canada and these other countries cutting.
And our last interview was about 7 or 8 months ago. I think it was December, January. And back then, the gold price hadn't rallied. It was stuck in a range. And we're just looking at the gold demand and the gold price in other currencies. And gold was at or near an all time high in pretty much every other currency except for the US dollar. For over 12 months, the US dollar gold price was lagging and we had a bit of a catch up. But the gold price, I think this is an important point. The gold price has underperformed all this accumulation of inflation in the consumer price index. So there's a lot of people out there like talking heads on financial television saying the gold price is going to crash again soon. And yes, it has had a correction in the last couple of days. It's below 2,300 today, but it still hasn't kept pace with the consumer price index. So it was overdue for a rally. I mean, there's a lot of gold bears, hedge fund managers. These are mainstream people. They've been shorting gold since November, December, and they're expecting gold to go below 1,800.
Yeah, that's a good point about gold against the CPI, because I've been looking at that quite a bit lately. And if you look at just a historical chart, I mean, gold, the inflation adjusted gold price is really close to breaking out of a 45-year base. I mean, that's still below the 1980 peak. So I think that like gold breaking through 2100, breaking out of this cup and handle pattern, obviously that's a very significant breakout. Like you don't see breakouts like that very often in the history of financial markets. But at the same time, the inflation adjusted gold price, it's coming up on a potential 45-year breakout. I think that could happen, sometime in the next 6 to 12 months. Maybe it'll be a little sooner, maybe a little bit after that. But I used to not care about the inflation adjusted gold price. But if you look at that and then you look at the Barron's Gold Mining Index, the gold stocks actually tend to mirror the inflation adjusted gold price. And it makes sense because, of course, gold stocks, generally they're going to follow the gold price, but they really follow margins. They really follow gold margins. And so, gold adjusted for inflation is a good indicator for the margins of the mining company. So that's why gold, if we get the inflation adjusted gold price breaking out of this 45-year base, that's going to be really significant for the gold stocks in the next leg up. But in addition to what you were saying, I may have mentioned this last time, but this is something I remember discovering, I don't know, 8 years ago, 7 years, something like that, where if you look at gold against foreign currencies, which another way of looking at that is just gold multiplied by the US dollar index. I was looking at that historically, and that leads the gold price. So gold strengthens against foreign currencies usually before it does in dollar terms. And yes, we've seen that in the last 5-7 years or so, where gold against foreign currencies has been so much stronger than gold in dollar terms. But usually, I don't have my note like handy with respect to the exact leadership pattern, but if I remember it correctly, I think at some point, like if the if the gold against foreign currency basket, if that makes a new all-time high and it holds for a couple months, then usually the gold price in dollars makes a new all-time high at some point in the next 6 or 9 months or whatever. So that, and I think that, that made a new all-time high at some point in the last year or 9 months or so, or 6 months or so. So that was a positive indicator for the gold price in dollars catching up. But yeah, that goes to show gold's relative strength. But I just come back to gold against the stock market. Like that, gold has made lower lows against the stock market since it bottomed in 2016. I mean, that's the one thing holding gold back from this like real spectacular bull market. And another thing that I look at, which you may have seen, is I created this index where it's the total return of a 60-40 portfolio. So this includes dividends. I spent some time getting data, and I constructed a 60-40 portfolio going back 100 years. And based on that chart, like that gave confirmation signals in 1972 and 2002, based on gold breaking out of this ratio, gold breaking out against the 60-40 portfolio. And that in the last couple months has been really close to breaking out and giving a confirmation signal, but it has not happened yet. And so 60% of that is gold against the stock market, 60% gold against the bond market. So bonds being performing so poorly in recent years, that has really helped that ratio. But again, the stock market has been too strong. So I just keep coming back to that when we actually see the stock market crack, I think that's really going to be when precious metals really explode. And not to belabor the point, but that's an indicator that we're still like in the first inning of this, even though gold moved from 19 or 2000 up to 2450 and silver made a move. Like in real terms, and you were talking about this using the CPI, in real terms, precious metals are still really, really cheap. Like they have not moved.
Yeah, and look at the miners. I mean, the miners, the Q1 earnings, Barrick Gold and Newmont, yeah, they had decent earnings. Yes, they didn't cut the dividend, but their free cash flow is getting eroded by higher mining costs. Their mining costs are still rising. So except for maybe a handful of the mid-tier gold miners, say like a Kinross Gold, a Lundin Gold, an Alamos Gold, a lot of the gold miners for the Q1 earnings, and yes, they weren't beneficiaries for the Q1 of the big $500 plus gold price spike. But you can just tell, like you said, that the costs are still rising. The other part of this picture that I think is really, really important, Jordan, and you've been in gold and silver markets. We've been friends since 2008, man. We used to talk on the phone all the time and over Zoom calls and stuff. I would argue that the supply and demand for physical metal for gold and silver has changed a lot in the last 10 or 15 years, especially with the Shanghai Gold Exchange. A lot of the demand for the actual physical gold and silver now, it's not coming out of the metals ETFs in the US or Western investors. A lot of it now, an enormous amount on a percentage basis, it's way more than Western investors. It's coming from like the Shanghai Gold Exchange. And you were seeing during our last interview, just a huge arbitrage. I think at one point there was over a $200 an ounce spread between the cost with the premiums for physical gold per ounce in the Shanghai Gold Exchange for metal and the gold price here in dollars. And I think there's still the silver spread was even larger than that, although I think the silver spread now is still at least $3 an ounce between physical silver in China and here.
Yeah, I mean those are great points, and that's something that I have been really slow to realize. It's not my area of expertise, and it's something. All that demand is, we know about the central bank demand that really helped gold consolidate in the last couple of years, really bullishly. I mean, it helped keep gold from falling back to 1,400, 1,500 that a lot of people are predicting. And it's a complete change from what we saw in the secular bull market in the 2000s. And this is something I was a couple of things, but one thing I was thinking about a couple of days ago, I don't know how to articulate it properly, but if you think about the secular peaks in precious metals, you had, is it 1934 or 1942? Like you can pick 1937 for the stocks. There's serious things that happen in the international monetary system. Like you have that. I mean, you have, of course, going off the gold standard in 1971. And if you again, if you look at the value of gold in real terms where it was at those peaks, even just leading up to those peaks. It's so much. I mean, it's like, gold would have to be like 20,000 to even like compare to what happened at those points. But my point is, if we think about what was going on in the international monetary system, and then we kind of think like what's happening now, where all these the BRICS countries, they're going to set up their new currency union, and they're all buying gold, and so China's bought a ton of gold, but they're taking turns. They've slowed down buying. Yet if you look at the last quarter, India bought way more gold in the last quarter than they did the entire year last year. So I mean, that's what Vince Lancy said, like they're taking turns, like that's what's happening. And so if you think like it's kind of, it makes me think about how precious metals performed in the 1930s and the 1970s. Like that's the kind of market that we're headed into. And the other point I wanted to, the other point. Okay, so we have had gold perform the way that it has. It was able to break out with the stock market still in a secular bull. So again, I go back. I know I'm just beating a dead horse, but what happens when the U.S. economy cracks and the stock market doesn't have to go down 50%. Like, what if we just have a mild recession and the market's down like 25%? I mean, what is going to happen to gold? I mean, it's not going to go down. Like I know this is a whole nother thing, but we can talk about that. There's many reasons for that, but based on all these new sources of demand for gold, it doesn't even include the stock market being in a secular bear. So what happens when the market and the economy crack? Like that's why I don't want to make extreme predictions, but I mean, if you throw that in the next 12 or 18 months, you're going to see gold like go vertical.
I think with the generalist hedge fund managers, and these are not people that cover commodities too much. Maybe they occasionally read some stuff, but they don't cover mining shares like you or juniors, and they don't pay attention to supply and demand of different commodities extensively. Is the narrative back in November, December was the dollar is relatively strong against other currencies. You have the yen and other Asian currencies were very, very weak against the dollar. The Fed had not cut rates. And the stock market was relatively high, like you said. So all these generalist hedge fund managers that are Keynesian, that think that all this credit in the system will cause deflation, the government will allow deflation, they were short gold. They were short commodities. That created kind of a short squeeze. And then you add in the supply and demand fundamentals, how there was so much demand, private sector demand, not just because central banks, Jordan, I would argue, are just dollar cost averaging. So they're kind of putting like a higher price floor into the market. The real big demand spike was out of like private sector for China, India, Japan, Thailand, Vietnam, Korea. That's where all the extra marginal demand, the big demand spikes came from. And that just overwhelmed the paper markets with the demand for the physical. And that's what caused the rally starting in October, November, December.
Yeah, I think you're right about that. What you said about central banks, they put a floor in the market. So all they're buying in the last few years, particularly I think in 23, that elevated the floor in the market. And that again, that's why the floor now is very conservatively you could say 2100. I mean, we'll know if we see gold move up in the next quarter or two, towards 3000, that'll elevate the floor further.
Yeah, I agree. And also the cost for the miners keeps rising. And I think it's a combination of factors. So it's the higher cost of capital with the interest rates at these levels. It's in emerging market countries where there's weak currencies and the workers are demanding higher wages, higher electricity costs. The miners structurally, from the deposit standpoint, we were talking before we started recording, these miners like Barrick Gold and Newmont, they're looking for only now 10 million ounce deposits. Newmont Mining said basically that they're going to be selling all of their deposits that don't meet that criteria. So all of their like reasonably sized mines that are below 10 million ounces, they're going to be selling off for cash. And so they're only looking at large deposits. Well, a lot of those deposits are not super high grade and there are a lot of capex to build. So I don't see the industry being able to find high grade, low cost deposits, especially if they want to find 10 million ounces of reserves or a resource that large.
Yeah. And it's why I think in this particular cycle, and I just mean the next 2 or 3 years, why I see a real risk of this move going to 5,000, 6,000 gold. I know it sounds ridiculous, but if you look at, my bull analog charts and you look at past cyclical moves in gold and you just project forward. I mean, I have the chart on my screen right now. Like if this move in gold were to duplicate the '05 to '08 move and then the '08 to '11 move, like that move would peak, based on how I look at it, close to 5,000 about 2 years from now. So what would, yeah, I mean, I guess that's kind of close to a double. But my point in mentioning that is think about, what you said about the struggles of the majors, and then think about, what happens if this bull market continues in gold, and and given the breakout we had through 2100, like this particular cycle, I think it should be stronger than the '05 to '08 and the '08 to '11 moves. That's how I get, 5,000 and then 6,000. But you think about that, think about just the nonsense that's going on now with the roaring kitty guy and, all these Bruce Jenner or Caitlyn Jenner has a crypto coin now. There's like a cum rocket coin. What do you think's going to be happening when we see gold break out? It gets to 3,000. It keeps moving higher. The stock market is in a bear market. Like you're going to see some huge speculation in precious metals, and I mean, you'll see big money buying the the big stocks, of course, but based on everything you're saying, like the industry, when I say the industry, I mean like the big money and the majors that you're talking about, like they need the juniors. They're going to have to buy the juniors. Like they're going to need new discoveries, they need new deposits, and that's why I think we could be setting up for just like a mini mania over the next 2 or 3 years. Now there's, things that have to happen for that to happen. You need a recession, you need a downturn in the stock market. And, obviously you need gold performing well at the same time. But if you think about what's happening in society and just all the fraud and, all this stuff with crypto and the roaring kitty and, well, and I think about that, and I think I come back to what you were saying about the struggles of these larger mining companies. Like it's a really good setup for junior companies and high quality juniors. And I mean, at the same time, there's going to be a lot of fraud, and there's going to be a lot of dog shit juniors that money will go into those as well. Like we see money going into crypto now. But anyway, I'm trailing off, but that's what I think about. When you mention the struggles of the larger companies.
Yeah, it's structural with ore grades and costs rising, and then just a philosophy from Barrick Gold and Newmont. What the public comments of the CEO from Barrick Gold and the CEO, the same one, very similar comments from the CEO for Newmont Mining just in the last couple of days in his article on mining.com. And he was talking about basically how Barrick Gold and Newmont Mine, they need to focus also on copper supply, growing new copper supply too. So it looks like they're not against buying copper and gold mines that have where the majority of the economics of the deposit are actually in copper produced. So they're looking like at the long-term demand for copper with what these data centers and new technologies. And they're saying, well, we need to hedge against potentially gold demand falling, or maybe it's just easier for them to find an economic copper mine. But if you're looking for better gold exposure, I mean, the Newmont Minings, the Barrick Golds, these are not the safest companies. They're not necessarily going to go bankrupt, but they're also not each quarter going to consistently generate free cash flow and have dividend increases like some of the royalty companies.
Yeah, I mean it's just, and again, I'm not, this isn't my area of expertise. I mean, you're far more knowledgeable about the large companies, but it's a really hard business for numerous reasons. And of course, these stocks will probably do well because you're going to get valuation expansion as the bull market continues, and they'll have higher cash flows and all that. But it's just they're very difficult businesses. They have to replace a huge amount of production every year. They have to find new mines, and jurisdictions now, like what someone told me in the industry, they said every jurisdiction is now worse than it was 20 years ago. So it's not just like people are thinking, oh well, that jurisdiction's bad, I can't go there. It's like every jurisdiction is now worse than it was 20 years ago. So, yeah, I mean, it's really wild to contemplate um, everything that's going on. But yeah, I mean, I know you're a big fan of the royalty companies, and geez, if you look at, I mean, look at the charts of, look at the 20-year charts of Royal Gold, Wheaton, Franco Nevada. I mean, those are some pretty sexy looking charts. I mean, they could still run a lot. Compared to, look at those charts compared to the majors, and that'll tell you everything you need to know about the businesses.
Yeah, or the regular gold mining ETFs like a GDX or GDXJ, and how both of those mining stock ETFs have vastly underperformed the gold price over since 2009.
Yeah, and the other thing about when you're buying bigger companies is it's such a cyclical business that typically a lot of investors, um, the Graham and Dodd or the Buffett types, they're looking for good businesses, and so they're looking for good numbers. But by the time like all these numbers look great for the big companies, like that's actually when they are the riskiest, because it is such a cyclical business and it's such a difficult business that a lot of those stocks, like they make their biggest moves coming out of downturns or coming out of crashes like the 2008 or the COVID crash, like that. Those are the times, like when as a investor, when you have to buy these stocks. I mean, if you buy them when they're already up or at all-time highs, I'm not saying they can't continue to do well, but you really have to be a contrarian when you're looking at the big companies.
And for a lot of the gold miners, you mentioned the royalty companies. I went and looked back at the max charts for a lot of these gold miners and royalty companies since 2009, 2010 to present. And there's only actually about 5 gold stocks that are up enormously that are either on par with the increase in the actual gold price or beating the gold price. And you mentioned 3 of them. 3 out of the 5 are royalty companies. So Franco Nevada, Royal Gold, Wheaton Precious Metals. Those companies are all generating a lot of free cash flow now. They're not cheap necessarily, although Franco and Royal Gold are lagging. And Royal Gold just announced, I think, a 7% dividend increase. But there's only 2 gold miners since 2010 that are actually doing well. And one of them was Agnico Eagle, which bought Kirkland Lake Gold and got what Detour Lake, which is one of the top mines. And now Agnico owns 2 of the best mines in the world, both in Canada, that are low cost. And the other one's Lundin Gold. So those are the only gold miners that have actually done well over a very long period since 2009 or 2010.
Yeah, and the other point I was going to make, well, actually 2 points, but the other point I was going to make, like GDXJ, like I try and find the small juniors that are going to go into the GDXJ in 2 years because they've performed really, really well. But by the time they get to that point, they're already much bigger. They don't have as much upside. And then you just think about how difficult the business is. Because if you think about a small producer, yeah, they can go from 50,000 to 200,000 or 100,000 to 250. But when they get to that point, like it's like 20 times more difficult to continue to grow. Like when they get to 200 or 250,000 ounces per year, it's like impossible that they're going to grow to 500,000 or even 400,000. Like it's really, really difficult. And
how much did they destroy their capital structure? Let me add to your points there. How much did they destroy their capital structure? How much debt did they risk the company on to add to the balance sheet, like Argonaut Gold, right? Building the one mine there and potentially either going bankrupt or selling the assets for pennies on the dollar, or share dilution followed by reverse stock splits and share dilution. So that's a risk with the smaller companies.
Right. Yeah, I mean that's execution risk, and well, I guess that was more capital risk or inflation risk. But yeah, cost blowouts are really common. That's why I'm not a huge fan of companies in Canada. I just think you have higher wages there, and I just think the climate. I just think it's just you're prone to more cost blowouts there. But another thing, I guess I'll tease the audience. There is a company I do own, which I think is setting up to be another Lundin Gold. Like they're about to start producing in or their first mine is I think it's probably in the next month or two. They made an acquisition. It hasn't gone through yet, but they acquired like a very prospective exploration project. So this is a company that they're going to have two really good mines in probably 4 years or so. That looks like it could be another Lundin Gold type company. So those are the companies that I'm trying to find. And at the same time, like following the market every day and technical analysis is great, and trying to predict, interest rates and all that stuff. Like if you think about a lot of the most successful investors, like they don't worry that much about macro. Like they're doing company analysis. And so that's something I've veered more towards that in the last year or so. Predicting markets and charts, and I mean, trying to market time everything and do that with your stocks. I mean, common sense, if you have something that goes up a lot, if it gets overvalued, you can sell half of it. If, something is really undervalued, you could buy it. But the difficulties in investing in commodity companies and the companies that we're talking about, Jason, and just the difficulties with the business. Like I would just urge people, like, get to know the companies that you're investing in. Like I guarantee you, everybody listening, like you're not spending enough time researching companies. Like it's fun to listen to podcasts and people like me saying gold could go to 5,000. I know that's great, but you're going to benefit way more from researching companies. Like listen to company interviews if there's good ones out there. You really get to know these companies, read the filings, talk to people, and spend as much time as you can on that. Like that will help you as an investor. Like you're going to get way ahead of the crowd, and you're going to learn a lot about these industries, and you'll understand these companies much, and that's going to help you make way more money in the long run.
Oh, I totally agree. I mean, there's tons of people that either didn't buy Cameco, which is the uranium miner. They didn't buy that stock at all when I was writing articles about it in 2020, 2021, and early 2022, when the shares were between $8 and $16 a share. Anytime it rallied, I mean, I was getting messages from patrons that they were going to sell the stock. They had no faith in uranium. They thought there was not going to be any uranium bull market. The shares, Jordan, a couple of years later, they're at $53. That's a huge move. And there was a lot of people that either didn't buy the stock at all, or they sold out too early. They didn't, stick with it and do the research. I was buying shares of Wheaton Precious Metals, and I was looking like I was getting the same types of reading the same types of articles and complaints from patrons that people are saying now about Sandstorm Gold was happening back then with Wheaton Precious Metals, because they were buying smart assets and royalties and streams, and a lot of them were under construction and they hadn't started to cash flow yet, but the debt is going to start coming down rapidly. My cost basis for Wheaton Precious Metals, and I haven't sold my shares, is between $11 and $15 a share, and they keep increasing dividends. And I've owned the stock for over a decade. So there are good businesses out there. You just have to do the research and find them. And if it's a good business and there's growth involved and they can grow dividends or free cash flow, those are the ones you probably want to hold long term.
Yes, absolutely. I mean, that is the real name of the game, how you're going to be able to make money and and I should say, even use like a bull market, the one that's barely started and the one that's coming. You could use that to your advantage, because it's all about these commodity industries. Like, build your own ETF. I mean, of course, everybody's different. Some people own 30 stocks, or some people might own 3 or 5 stocks, but build your own GDX. If you're into energy or uranium, build your own URA, because you build your own ETF. And if you really spend the time researching these companies and become an expert, call these companies, like, talk to the executives. If you do that, like, you're going to make a lot of money, and you're going to outperform these sector ETFs. Like, this isn't a thing where you can just, commodities are not a thing where you can just, like, okay, I'm just going to buy the commodity ETF and I can do nothing for 5 or 10 years. Like, it doesn't work like that.
There's the agriculture ETF, which is based on futures contract, the DBA, but I think Sprott Inc. is a good one, because they just keep coming up with new metals trusts. They're launching a copper metals trust now and a copper miner ETF. So I mean, they've been having a lot of success owning these, launching these new metals trusts. The uranium trust is very successful. The uranium mining stock ETF is traded a lot. So they have what, physical gold, physical silver, a combination of the two, platinum, palladium, uranium, and now copper physical metals trust. So I think it's pretty smart what they're doing. And yeah, the most important thing, Jordan, they're not mining. So you're not taking all the mining risk where the metals price goes up and your profit margins get destroyed.
Right. And that's another way to do it. But I enjoy investing in and researching and following the companies.
So I want to ask you then about some of the companies you do cover. You told me that your newsletter covers about 15 to 20 juniors. Are they starting to raise, I don't know, 10, 15, $20 million pretty easily in private placements without warrants for actual drill programs now?
Um, I would say, I mean, I'm just pulling up my list of companies. I own a few. If I'm thinking, I have a top, I have a top 10 list and a watch list. If I think about my top 12, um, most of these are producers or they're about to become producers. I think I have one or two um, explorers. But yeah, these are like the market caps on these. I mean, I think the median market cap of my top 12 is around, I'm just looking, call it 500 million or 550 million. So I have some that are around a billion and some that are, 100, 200 million. So yeah, most of these companies are not having issues um, raising money. So I mean, thinking about your question, it probably pertains, I would say, to the bottom of my top 12 list. And, there's one company that I really like that, I know that um, they're doing a combination of like, they're going to build a mine and they're doing all three, like they're doing equity, debt, and a royalty. Um, I think if you like if the project is a quality project, it will get financed. Um, and so the companies that are having trouble, like those are the ones that just the projects are really not that great, and there's probably more risk. And I know like early stage companies and exploration companies don't really have anything. I mean, they're having a harder time financing those. Now, if we get a big move in gold in the second half of the year, then I think it'll be easier for everything to get financed. But here and now, I would say if you have a quality asset or a quality project, there's no you have no trouble being able to finance that. And so I would say yes, like the quality things, the quality juniors, obviously they've moved a lot already, but not a huge amount. And so this correction, if it can, I'd like to see it continue because that would, pull down share prices in these high quality companies and improve valuations. And I think that's important because if we're doing another interview in 6 months and you have gold 2,700 or 2,900 or 3,000, it's tough at that point because then a lot of the quality names will have already moved so much that like it's so hard to buy them at that point, even though they're high quality. And so at that point, then maybe you almost have better value in the lower quality things. So that
Do you
that to
think
me,
do you
yeah,
think
I'm
the
sorry, go ahead.
probability do you think sorry to interrupt you, but you just said like 6 months, 2,700 gold. You think the probability is high we can get there in 6 months?
Yes, I think because looking at the analogs, like I have a chart that's a breakout analog of gold. I don't think I posted it publicly. I may in the next week or so, but this just compares all the moves in gold. Like how did gold move after the 6 or 7 breakouts in the last 55 years? And basically every move will have come close to 3,000 by the end of the year. So If we're looking at the preceding moves, if I'm looking at that, and I'm also looking at, I have not a breakout analog for gold, but just a bull analog chart that also shows that 3,000 by the end of the year or early next year is really doable. So I do think that's, that doesn't mean that, again, you don't want to be reckless with your investing and, buy futures contracts or option calls based on what I'm saying. But looking at the history here and the technical setup, I do think we could hit around 3,000 in the next, 6 to 9 months in gold.
So for the companies you cover in your paid newsletter, do you actually do you target like companies where the share price is down on the Lassonde curve? Because I started researching this over the last couple of months. I found charts on this from Pierre Lassonde, the guy who started Franco-Nevada, but he's also built other mine companies as well. And basically, like with the Lassonde curve, the valuation of a mining company when they're building the mine, it crashes. But then, like statistically, and I was talking to Lobo Tigre about this, and he's a newsletter writer too, similar to you, except he actually goes and visits the mine sites and he has geologists on staff. And he says statistically that companies that are coming out of the bottom when the shares crash, when the mine is being built, that those are kind of good ones, like those juniors that you were talking about, where they're building the mine now and the share price has already crashed. And then once the mine goes cash flow positive, he's gotten good returns on, investing in the Lassonde curve there in a specific spot.
Yes, I would say for me that is the real. I mean, you look at the Lassonde curve. There's two times you want to buy. The first is when the company makes a discovery or they're growing a discovery. But I mean, I don't want to say that's gambling, but that's a lot more difficult because you need to have drill success, or I mean, you can have the smartest, most seasoned geologists in there. I mean, it's like baseball. They're not going to get a hit every time. Every prediction they make is, that this is going to be the next big thing is not going to pan out. So that's a lot more difficult. That's why for me, I do favor exactly what you're talking about. Like I tend to like if they don't have any mines, then and they're building the first mine, I like to look at something that, it's a quality project. Doesn't have to be the greatest project, but it's a quality project. It's economic. The current valuation is good. They're able to finance it without destroying their capital structure. I mean, this is where, thank God for the royalty companies. So you have all those elements, and you look at the value. In addition to that, I especially like when it's like a phased approach where maybe it's a big mine or it's a mine that has huge potential, but we're just going to do a startup first and get it going, and then we're going to expand it. Like that, those to me are like
so in stages. So like they build phase one. They build phase one for some cash flow, and then they're generating free cash flow and profit margins. And then what the plan is phase two, like a couple of years later, like that.
Yes, exactly. I mean, those to me are the real juiciest ones. Now, if a company already has a mine and they're building another mine, I also like those situations as well. I mean, production growth, that's what you want in a bull market. You're in the mining business. If you're not mining, if you're not growing, you're literally dying because you're mining your product. Like you're basically consuming your product every day. It's about production growth, and it's about being able to build mines that have huge economic potential. So yes, I mean, I would say of my top 12, like 10 of the 12 center around that. And I'll go back to the one I teased. And again, I mean, I'm sorry I can't mention names, but it's just I have a service and I don't cover like 100 companies, so I don't like to give away info. But the company I was talking about before, that could be another Lundin Gold. So okay, like they also, they're about to start production. Their first mine, it wasn't the cheapest to build, but they had a great financing package. I won't say the name, but a royalty company, one of the best, finance them. And so they're going to get that going. They're going to have a lot of cash flow from that. Now that we're in a bull market, they're going to have a huge amount of cash flow and a strong stock price to help them fund this second project that they just acquired. So that's another example of when you go from one to two, like you get the first one going and you generate a lot of cash flow, then you can use that to help you build the second mine. So it's all about, how can you build these mines and develop these projects without destroying your capital structure. I mean, I avoid in the majority of cases, if it's some huge, oh, this project has like an 800 billion capex or not 800 million. I mean, 800 billion, I hope not. But, these projects that are super expensive, I tend to avoid those. But yeah, to button up this issue, yes. I mean, the production sweet spot in that Lassonde curve, going from development to successful production, yes. I love that. That's the number one thing that I look for.
And actually, that's funny you bring up Lundin Gold, because the rumors are they're actually looking to go and buy something else, because they have the one really amazing mine, Fruta del Norte in Ecuador, which is generating an enormous amount of free cash flow, and it has enormous exploration upside. They keep finding higher and higher grade on the drill hole results, but the rumors are they're looking to go and buy something soon.
Yeah, and I'll just another thing, you mentioned it before, but you also mentioned it there. I call it the holy grail in mining or junior mining, and that is when a company they're in production and they're mining, but at the same time they're still committed to exploration around that asset. Because if they find something good, like Kirkland Lake is the number one example of that in the last 10 years. If they find something good, they don't need to build a whole nother mine. Like they can they can mine that, and process it at a very, very low cost. And there's actually a company on my list. Actually, they well, I'm going to hold that thought, but a company on my list, they're going to go into production probably in the next year or two. But what they told me is, like, there is a really rich area. They know, based on all the history, the historical data that they have, but they haven't drilled it because it'd just be way too expensive to drill it. But they're going to start mining and get underground, and when that happens, they're going to have easy access to drill this area. And so they think this is a rich area that they can tap into once they're in production. So, and maybe it doesn't pan out, but my point is, you can still invest in exploration. Find the producers, like you were saying with Lundin Gold, find the producers that are still doing exploration and can still unlock more value and potential from the asset that they're mining. I mean, that is the real holy grail when you're looking at these junior companies. Look at those types of situations. You don't have to go and gamble on drill holes with a 10-cent or 20-cent exploration company. You can invest in the best. And granted, that doesn't mean every one of these has exploration potential or every one is going to pan out. But, I can name 3-4 of these types of situations off the top of my head. And, again, maybe only 1 or 2 of them are going to pan out. But, if you think the reason why this is so important, because think about what happened with Kirkland Lake. It's when producers already have the mine built and the processing facility, when they make these new discoveries, I mean, it's free. It's like free money for them.
It's lower capex, so they already have the infrastructure around the mine. They're maybe extending it. It's a lot less capex bill. So I think what you're referring to is the Fosterville mine in Australia, because it was a tiny little mine initially for many years when Kirkland Lake Gold first owned it, and then they drilled below the existing mine deposit, and they found much higher grade gold. And I would say for about 7 or 8 years, the Fosterville mine was the highest grade and best profit margin producing gold mine in the world. It was there in Australia, and now it's like sputtered out. But the management team at Kirkland Lake Gold, they were able to go and buy the Detour Lake deposit. And initially, like, I was reading a bunch of articles on that mine, and it wasn't supposed to be that good. But the CEO of Kirkland Lake Gold, I mean, he saw that after the first couple of years, he could optimize the mine and fix it and get into better economics of the mine. And now it's one of the top mines in Canada, if not the world. I would say Detour Lake is probably top 5 along with Canadian Malartic. So, and then Agnico Eagle bought the mine. So you can have exploration success. It doesn't always work out like Jordan says. I think Greenstone's going to end up being one of those in Canada, because Greenstone's probably another couple quarters away from economic production, but Equinox is going to reinvest those profit margins and free cash flow at Greenstone. It's going to go into exploration drilling. And Rick Roll just said on a recent interview that I did with him, he said the odds are pretty high that they could potentially find a second deposit around the current Greenstone open pit.
Yeah, I mean that's another example of exactly what I was talking about. And this, another reason, I mean, it's master of the obvious, but think about what you were talking about before about the troubles that the senior mining companies are having. The cost inflation, trying to find trying to look for new projects that they can buy or build new mines. I mean, they're looking for 10 million ounce projects. That stuff is really difficult and it's really, really expensive. And so again, producers who they get the mine built, they get the processing facilities and everything constructed. If they can tap into the exploration potential, it's free money because of what you said. Everything's already built. Like it's the capital to bring these new discoveries online is minimal. And for many of these companies, like they don't necessarily need to find like 3 million ounces or even 1 million ounces. Like for some of these companies, if they tap into something and it's like 400,000 ounces of really high grade gold, or it's 500 or 600,000 ounces of decently, it's like a decent grade, has decent economics. I mean, that stuff helps these companies a lot. It doesn't have to be like a massive find to really enhance the value of these companies.
Well, the mid-tier gold miners are actually having more success at this. So as you mentioned, Lundin Gold, and I mentioned Equinox Gold. The other one is Alamos Gold with the Young Davidson mine in Canada. When that was first built, it was considered a mediocre mine, around like $1,400-$1,500 an ounce cost. But then they drilled off exploration holes with the free cash flow. Guess what? Costs haven't gone up that much. They've actually come down a little bit, but they had the exploration discoveries, and now the mine life was extended by another 20 or 30 years. So all that additional gold reserves that they found, like Jordan said, the costs are low on that additional discovery next to the existing originally planned mine deposit, and that's kept the costs at the mine from skyrocketing. And now Alamos Gold has one of the best low-cost mines in Canada with a long mine life.
Yeah, it's why the stock has done so well. But another thing, you mentioned Kirkland Lake, and Fosterville. And this goes back to something I said earlier, eventually, these things will run out, it's like, I'm just making the point that you can't.
Well, depletion. It's the depletion risk. Yeah. Well, but Barrick and Newmont have the worst one. Barrick and Newmont, because they're pulling millions of ounces per year out of the ground.
Yeah. You can't necessarily hold these things for 10 years. I mean, everything I'm looking at, I tend to have like a 2 or 3 year time frame. I mean, I think we're in a new secular bull that's going to last 10 years. But when I look at cyclically, how long do gold bull markets last? Like they tend to last around 3 years. Maybe it'll be 4 years this time. Maybe it'll only be 2.5. But so that's kind of my game plan with all these things. Again, it's with commodity companies. You can't hold these things for 10 years or even 5 years in many cases. So I'm looking at these things on around a 3 year basis. And so, yeah, all these new discoveries are great, but it doesn't necessarily mean you can hold these things for another 5 or 10 years. You do have to sell at some point.
Well, buying and holding gold mining stocks or copper miners, I mean, those things have drastically underperformed the metals prices. So long-term buy and hold, say 5 years or more, for a lot of these companies, it just doesn't work because of all the problems with the business, or the commodity price goes down, or the cost goes down, or the cost keeps going up. The profit margins get squeezed. Management like Newmont and Barrick Gold, they make bad acquisitions, and then they destroy the share structure of the amount of equity issued, because I think the amount of shares Barrick Gold has issued is 300% increase since the early 2000s. It's a massive amount of share dilution. We'll see if they do a reverse stock split or something like that going forward, but that's normally what happens in juniors. Last question, Jordan, before I let you go. So you have an extensive amount of experience covering these junior mining stocks and gold. What are some tips for our listeners out there how to avoid some of these fraudulent juniors that are listed on a Vancouver exchange? What are red flags that you personally look out for?
Well, everything needs to be promoted, but I would say there's several things. First, like use common sense. Like everything, um, has to be promoted to some degree, and you know, I would just be skeptical. I guess number one, just be skeptical of everything you hear. Um, and look, if I'm right, and we're going to go into uh, a really big bull market in the next couple years, like you're going to see a lot of promotion, a lot of dog shit being promoted, a lot of garbage, in fraud and all those things. So just you have to be really skeptical of everything you hear, and you have to realize like one thing about gold stocks, they're spectacular bull markets throughout its history. 1957 to 1980, gold stocks, I mean, they went up a spectacular amount. But within that, within those 2 decades, there were multiple 65% declines. There were 3 or 4 40% declines. So yes, I think we're going into a spectacular bull market in the next 2 to 3 years, or over the next 2 to 3 years. But if that comes to pass, like on the other side of that, you're going to get a 65% bear market. So you have to think about these things. When it comes to companies, I would say focus on the junior producers. Stay away from the exploration companies. Just they're a lot more. They're obviously a lot more risky. I mean, look, you can lose a lot of money on producers as well, but I would focus focus on the producers. Look for companies that are building mines, production growth. And I would also say, focus on, and you can still do this now because we're early enough in this move. Focus on quality in the high quality companies. Like they're still cheap enough. Like don't make the mistake of, well, gold could go to 5,000, so I'm gonna just buy a bunch of like 10 cent, 5 cent stocks and hope that they go to $5. They probably don't have any gold, so there's really no business there, really no value. I mean, you're just gambling completely at that point. I mean, I'm trying to look at quality companies that have the most upside potential. So I would still focus on quality companies. We're early enough in the bull market that you can do that, and you don't have to gamble on things that are lower quality. In addition to that, with respect to trading and investing, you'll figure out your own plan going forward. If a stock makes a huge move, maybe you sell a third of it, maybe you sell a half of it. Like you're not going to sell the top. Like nobody can predict price movements. You have to have your own set plan that will help guide you along the way. Because look, a lot of people in this industry, I mean, over the last 50 years, I mean, a lot of money has been made, but a lot of money has been lost at the same time. So you making money is not the difficult part. The difficult part is getting yourself a plan and figuring out how you're going to keep the money that you make, or at least keep most of it.
And a lot of money has also been stolen through bad marketing or outright fraud, like the Barrick scandal. And so, even though Canada has tougher laws like the NI 43-101 for an official resource estimate, I mean, there's still ways around that. You see that with, I mean, there's tons of blog articles about their warning about like, be careful about some of the drill hole results that are announced publicly. I mean, the stock may spike, but there's a lot of misleading drill hole results that are published in press releases. I think the important thing that you mentioned is the marketing part. So if the company, and unfortunately, all these juniors they almost all say that they have a high grade deposit. We have high grade silver, we have high grade gold, we have high grade copper. Okay, what are the average ore grades? Do you have a mine plan? What are the capital projections? Can you actually raise the capital? Have you raised some of it? That's like the important information that you need to see if the company, because if the company needs to spend $5 billion building out a copper and gold mine out in the middle of nowhere, and they don't have backing from a large royalty company or a partnership with say a larger or mid-tier gold or copper miner, I mean, how are they going to raise the billions of dollars to build a mine out in the middle of nowhere for that quote unquote high grade copper and gold?
Yeah, it goes back to what I was saying. Just be skeptical of everything that you hear. I mean, particularly with, respect to drill results and claims of stocks going to the moon. I mean, you have to use common sense also. If a stock chart looks like a rhino horn, where it's almost gone straight up, I mean, use your common sense. At some point, that thing is going to, I'm not saying it's going to go all the way back down, but you don't want to buy or invest in those situations when they're being over promoted. But there are good companies also get promoted too. And I would also say, you have to subscribe, like subscribe. I know I'm, tooting my own horn here, but, subscribe to my service. It's affordable for everyone, and subscribe, see if you could find a couple others that, have experience that you trust. And because if you have several people like that you can bounce ideas off of, you can email them or ask questions, like you're that's going to help you along the way. Like if you try and do it completely on your own, it's just really, really difficult. So you have to invest a little bit in, some research and analysis that can help you.
And the other thing there with marketing, like Jordan was saying, is you can go for some of these junior mine companies that are on a Vancouver exchange, and you can go look at the financial documents and look up what the company, they're going to have to disclose it if they're on a public exchange, what their marketing expense is, what the executives are being compensated with stock options or warrants, or how much of the capital they're raising in a private placement is actually going into drilling, and how much is going towards executive compensation or marketing or selling general and administrative expense. And as Rick Worrell said, if the company is spending 70% of the funds they raise on executive compensation and marketing on podcasts and YouTube videos and like going to conferences and trying to woo whining and dining like SEC accredited investors or institutional investors, and they're not spending it on drilling. I mean, that's not a serious company long term. That's like a marketing engine. It's they're not going to find a good deposit then.
Yes, there's lots of lifestyle companies out there. And that's why I say, and I'm sure Rick Rule says the same thing. I mean, just focus on the small percentage of legitimate companies and the small percentage of quality of companies within the bigger industry that are high quality. And you don't need to waste your time thinking about or trying to research those types of companies.
Yeah, I agree. So we highlighted some of the major red flags that people can go look up. Also, if there's a ton of net insider selling on a junior and the junior saying, "Oh, we're raising money," and "Oh, we just had a discovery," but the insiders at the company, and you can look up the publicly traded releases, are dumping all the shares. I mean, that's another red flag too.
Absolutely.
Well, I want to thank you so much for your time today, Jordan. I kept you for an hour. It looks like we're going to have a little bit of a correction for the gold price, but I think there's probably going to be some dip buying by private sector in China, India, Asia, other parts of Asia. It looks like there's a solid demand still. I haven't seen any announcements where there's huge demand collapses for private sector demand out of China, India, or Asia. And the People's Bank of China, I think, just announced in the last 12 hours that they're not buying this month for physical gold accumulation, but that doesn't mean they won't start buying a month later.
Yeah, absolutely. It's like Vince Lancy said. I mean, they're taking turns. When China's not buying, somebody else is buying.
It definitely looks like that. I mean, a lot of the data, I think China bought, or one of the other emerging markets bought 36 tons in the last month or two. So there was another 36-ton purchase, but it's definitely dollar cost averaging. It looks like a lot of the emerging markets. So this is all outside of the G7. So like the Bank of Japan, Canada, Australia, European Central Bank, Bank of England, they're not buying gold tonnage because they're allied with the US, but it looks like the non-US allies, the countries outside the G7, are the ones that are dollar cost averaging gold.
Yeah, and I think they'll probably continue to buy, and that just, like you said, it provides great support for the market. I mean, the floor for the market just keeps getting higher and higher.
Yeah, I agree, especially with interest rates where they are, because cost of capital to build a new mine, if you're going to use debt, is very, very high. The input costs, even though energy prices are relatively weak the last month or so, I don't see them staying weak for that long, maybe 6 months or 12 months. But then the demand will pick back up if energy prices get cheap. But overall, Jordan, the input cost for a lot of these miners is still trending higher. I mean, we saw this with the Q1 earnings releases. I think the Q2 earnings for a lot of the gold miners, the producing ones, will be better, but we'll see. I mean, I'm still worried about cost rising, especially with cost of capital with debt and the input cost rising for the producing gold miners.